In the world of investing, there's never been a better moment in time that's offered more opportunity to investors than right now. In fact, there's so much opportunity, it can be overwhelming at times. But don't worry, we'll take you through it. And if you have more questions, Okay, let's take the time to explain the different categories of investments and why you might consider adding them to your portfolio or asking your advisor to do that. To start, we're not going to say categories anymore. We want to look cool in front of our friends and anyone in the financial space, so we're going to call these categories asset classes. Like that? All right, now each of these asset classes exposes you to different groups of securities. First off, we have equities, or more commonly, stocks. Now, a stock represents partial ownership of a company. When you buy stock, you have the right to vote on some of the company's decisions, like who gets nominated to the board of directors, things like that. Now, you also have the right to receive dividends if the company pays them. Now, a dividend is just a payment that the company gives. It represents a portion of their earnings, and you're entitled to it. If you are a shareholder and the company pays dividends, then you're entitled to those dividends. And trust me, they do add up over time. Most people don't buy equities for the dividend though, they invest for the overall appreciation of the stock's value, also known as capital appreciation. To dumb it down, basically they hope to buy low and sell high. Okay, the next asset class is commodities. Now, one of the main reasons that a portfolio manager or yourself would add commodities to your portfolio is correlation, or the lack thereof. See, usually commodities move in the opposite direction of equities, at least to some degree. Also, fixed income tends to act the same way, but we'll get to that in a second. The challenge used to be that you couldn't invest in commodities like oil and expect to store barrels of oil all over the place. I mean, God, my wife hates it when I leave a cup of coffee on the table. Could you imagine if I had barrels of oil all over the house? All right, anyways. But listen, with futures contracts and now with ETFs, investing in commodities is as simple as the click of a button, right? Moving on, fixed income is a very popular asset class that's seen as less risky than equities. Now, fixed income is a way to invest in companies that are looking to raise money. They raise money by issuing bonds, which you would purchase. This is like making a loan to a company. In exchange for this loan, the company will make regular fixed payments to you with interest. That's why they call it fixed income, because of those fixed payments, right? Now, it's generally believed that fixed income is less risky because if you agree to a loan to the company, they promise to pay it back, whereas stocks don't make that promise. Okay, next we have currencies. In this asset class, investors are simply making a bet as to the direction of a particular currency. Nowadays, you can use ETFs and bet on the direction of all the major currencies, along with some of the emerging market currencies as well. All right, lastly, we have alternatives. Now, these get a little bit tricky, and they're usually suggested to be left to the pros. Adding alternatives to your portfolio allows you to participate in things like market volatility or even the shape of the yield curve. Still with me? Okay. Now you know the difference in asset classes and their uses. Hopefully this is helpful and it helps you categorize that maze of investment opportunities that are out there. But if I left you confused or possibly wanting more,